Okay, and welcome to this discussion of monetary policy's transmission mechanism, which is a fancy way of saying we're going to draw some graphs that will show us how the policies used by the Federal Reserve Bank get transmitted into affecting the economy as a whole. So you have a couple lists here about the basics. If it's a recession, you're going to implement, or the Fed would implement easy money policy. They're going to buy bonds, decrease the reserve ratio, and decrease the discount rate. If the problem is inflation, we use a tight money policy, which involves selling bonds, increasing the reserve ratio, and, oops, mistake, increasing the discount rate. All right, so here's the basic idea. It's really three parts. First part, you're going to draw the AS80 model where you're going to show the problem and the solution. The second part, you're going to draw a money market, okay? And in the money market, you're going to shift the money supply curve based on the correct policy. Finally, in the last one here, you are either going to draw an investment demand curve or a loanable funds market to show how the change in the money supply and the resulting impact on interest rate affects either the quantity of investment or the quantity of the demand for loanable funds. Remember, businesses and individuals are more likely to borrow more money at lower interest rates than higher interest rates, and that provides the solution, okay, which is an increase in aggregate demand, mainly because of investment increasing, or consumer spending could go up as well for durable goods, things that people usually finance, like cars or I don't know, big ticket items, refrigerators, etc. All right, so the transmission mechanism looks like this. First thing, my ASAD model. We're going to stick with, starting off with a recession. Okay, so I put my current level of output versus my potential output. Remember, you always need a long-run aggregate supply curve. Make sure you label your axes clearly. So in this case, we have a recession. We're going to then look at how the Fed actions are manifested in the money market. Here's my money market. There's my money supply curve. My nominal interest rate. My money demand curve. So the Fed is going to either buy bonds, lower the discount rate, or lower the reserve ratio. The result of which will be an increase in the money supply curve. And that lowers interest rates. So one way for us to see how this is manifested in something that could affect aggregate demand is we simply carry over our interest rates and show the effect on an investment demand curve. You could put a real interest rate and nominal interest rate. I think the point is that we're impacting the price of borrowing. So if this is the original interest rate, and this is the new interest rate as the result of the correct Fed policy tools, we're going to have a greater quantity of investment demand. When businesses are borrowing more and investing more, we get an increase in aggregate demand. When we draw into here, there's going to be some inflation, but we get back to our potential output, and that means we get rid of our probably what is an inflation problem. All right, let's do a sample one here. We'll let you do it by yourself. Real GDP increases in this particular problem by 0.25%. Think about what the target numbers are. The CPI increases by 7.1%, and unemployment remains 4.2%. So go ahead and pause at this point, and then write your solution, draw your monetary policy graphs, and then I'll show you the answer. Okay, based on this information, this is too low, This is too high, and this is too low relative to their target numbers. Now, it would be great if we had really low unemployment without much inflation, but that's not the case in this particular example. So the problem is inflation. What does that look like on my ASAD graph? We are beyond potential. Our current output is greater than our potential output. Okay, so what are we going to do about this? Well, the Fed has three options as it implements tight money policy. One option, the most popular option, is to sell bonds. The second option would be to raise the discount rate. And the third option would be also to raise the discount rate. So when those three things happen, we want to see how they are going to impact monetary policy, or how they're going to impact the money market first of all. So first thing we're going to do is draw our money market. Perfectly inelastic supply curve for money. Money demand. Here's our interest rate, quantity of money. Now we're going to see a decrease in the money supply curve. Okay. Interest rate rises. So in this example, I'm going to use the loanable funds market as our example here to see the impact of this change. Well, in this case, let's draw supply of loanable funds, demand for loanable funds, and if there's less money available, there's less money to save. So we get an increase in the, or decrease, excuse me, in the supply of loanable funds. And then it happens, interest rates rise, people don't borrow as much money, businesses don't borrow as much money, and we less spend. Less spending means aggregate demand is going to decrease. And when it decreases, we get rid of our problem. In this case, it's inflation. So showing these graphs again and again. Again, this is called the transmission mechanism. We're really talking about looking at how these two graphs right here can help us explain this change in aggregate demand. Thanks a lot. Study hard.